Welcome to Predictive Analytics in Finance. This self-running presentation provides a detailed understanding of predictive analytics modeling logic that was introduced in an executive summary presentation of the same series. If you haven't viewed it, you may find it helpful to do so before viewing this one. Provided on the screen is a summary of the objectives of this presentation. The primary objective is to provide a detailed understanding of predictive analytics modeling logic and how it differs from EPM. In addition, it provides a foundation for other presentations in this series, examples of which are shown on the screen. This slide was introduced in the executive summary presentation. It provides a summary of predictive analytics modeling logic that is supported by simulation or flow-based predictive analytics. The focus of this presentation will be to explain the relevance of all 12 of these different types of modeling logic. One of the things that was introduced in the executive summary are the 3 business capabilities that predictive analytics support. We'll come back to this slide after describing the modeling logic. Most of this presentation will focus on predictive analytics modeling logic, which is depicted by the graphic in the middle of the screen. However, it's important to understand the other 4 components of these applications to really appreciate how they support planning processes. The first thing to appreciate is that predictive analytics supports the same types of financial reports as enterprise performance management, such as profit and loss, balance sheet, cash flow, etc. Second, it provides the means to import and export data from other sources. This is important because the role of predictive analytics is to complement EPM in the planning process. As such, data will need to be imported and exported to and from EPM. The third is model management. The core of the model, which is represented by the graphic in the middle, is usually managed by a limited number of modeling experts. Frontline people don't need to understand the details of how it works. However, model management interfaces provide the means to engage them in the process of maintaining these models without having an expert understanding about how the models work. The last is scenario management, where model parameters are made to drive the scenarios. A key component of scenarios is also the ability to quantify component variances. What's left now is the model itself, which we'll address in the next slide. What you see on the screen is a generic depiction of what a flow-based driver model typically looks like. Most predictive analytics applications use interfaces that look something similar to this. Behind these interfaces is predefined modeling logic that translates market demand into financial and operational plans. We'll come back to this driver model shortly, but first, I'd like to address one question that often arises when finance professionals view these models for the first time, especially those that have used EPM applications. And that is, why should finance use what appears to be a very detailed and operationally based planning approach? The answer to this question will become clearer as we get into the details of how these models work. In doing so, we'll address other pertinent questions, the most important of which are the first 2 on the screen. The answers to the others will provide further details about the differences between planning approaches supported by EPM and predictive analytics. So let's get back to the model. At a high level, what flow-based models do is to translate market demand, shown on the left, into resource requirements, shown on the right. This is accomplished by modeling the actual physics of operations that deliver goods and services. In supply chain organizations, this includes inventory levels, as well as the resources required to produce, procure, store, and transport them. These requirements then drive operational plans, which in turn are translated into financial statements. The following are of note about this approach. Each of the modeling nodes and connectors you see on the screen are created by drag and drop modeling. Behind these nodes and connectors are predefined logic that users configured. There is no coding. And the modeling logic in these nodes has both financial and operational components. One thing to remember about predictive analytics is that they are planning and modeling platforms. Like EPM, these applications start off with a blank slate. The job of users is to design and configure them. There are a few basic things to understand how flow-based models work. First, the model simulates the physics and financials of each individual flow. Second, the number of possible flows is really driven by the number of model nodes. In the example on the screen, there are 20 model nodes representing 1,080 potential flows. You'll see at the bottom how this is derived. Now this is a very simple model. It illustrates that a significant amount of detail can be obtained from a relatively small model. Large organizations can have hundreds of nodes and therefore many thousands of flows. While this supports some very detailed planning, it does so while simplifying the development and maintenance of the model. This is one of the most powerful features of such advanced modeling platforms. Now let's understand this notion of model node in a little bit more detail. Now when a model node is opened, the user is presented with a menu of parameters that can be used. These fall into two broad categories: financial and operational parameters, examples of which are shown on the screen. Operational parameters define the process flow, where the activities are performed, and the time and resources required to perform them. A key output of these parameters is the quantification of work and related capacity constraints. Financial parameters define the means by which operational plans are translated into financial terms. These are fairly self-explanatory. Those of you that are familiar with ERP systems will appreciate that such parameters are similar to models of bills of materials and routings that these systems contain. Employees from finance, operations, engineering, marketing, and product development can all own pieces of the model. The principle here is precisely the same. Flow-based models can be designed at both a high level and a detailed level. It really depends on your objectives. The number of nodes used depends on your objectives and the types of questions that the model will address. Provided on the screen are examples of the types of questions that one would ask in developing and designing a model. The main thing to take away here is that these models can be designed for any financial or operational purpose. Now that we've provided a brief overview of the model, let's come back to the specific modeling logic differences between predictive analytics and EPM. These will be the focus of the slides that follow. The first logic capability that we'll address is dynamic drivers. Now EPM applications support this to a point, but here's where the complications arise. A classic illustration of this has to do with how changes in the volume and mix of products and segments can have a significant impact on downstream resources and costs. On the left side of the screen, you'll see three circles denoted 30%, 40%, and 30%. These percentages represent the amount of volume going through these different customer segments and channels. Now this upstream mix really drives the downstream mix that you see in the production processes shown in the pink boxes, which are 20%, 60%, and 20%. Now let's assume that the demand or segment mix on the left-hand side of the screen changes to, say, 20%, 50%, and 30%, as denoted by the black circles. The downstream impact on production processes might be to change the mix to 40%, 50%, and 10%. Flow-based models provide the means to make these adjustments automatically. Moreover, they do so in a way that is financially and operationally correct. Now, EPM doesn't support these types of flow-based capabilities. In smaller and less complex organizations, logic can be developed that emulates it. But in larger companies, this isn't the case, which accounts for why such organizations often have the following types of experiences with their planning systems. First, they often spend a lot of time maintaining key assumptions in offline spreadsheets. Second, scenarios take a long time to run because of the time required to update key assumptions manually. Third, scenarios aren't always accurate because assumptions are not always valid across all scenarios. Fourth, organizations don't always have visibility into risk because only a limited number of scenarios can be run. This, in addition to the fact that scenarios aren't always accurate. The net impact is that in complex organizations, EPM is not always supporting the type of scenario planning processes that are desired. Modeling capability gaps that will be addressed in the slides that follow further illustrate this issue. The next modeling logic difference is that predictive analytics support time-phased models. Any model parameter can be varied over time. The first thing that can be changed is the flows, as depicted by the yellow lines on the screen. The other parts of the models that can be time-phased are the nodes themselves, as depicted by the blue boxes on the screen. Now, time-phasing models is highly relevant to quantifying the impact of new products, processes, mergers, and IT projects. It's also relevant to other logic issues, such as cash flow forecasting, which will be addressed in the coming slides. Now, EPM can partially support time-phased models with additional dimensions. But there can be limits to this as dimensions are added, especially in complex organizations. This issue will raise its head again in the coming slides. Providing forward-looking process costs is another capability supported by predictive analytics modeling logic. In the example on the screen, this means that for each of the 1,080 potential flows, predictive analytics calculates the cost of each. But the model is calculating more than just total process costs. It's also providing the type of financial and operational information shown on the screen. One of note is cost per outcome, shown at the bottom of the screen. The ability to deliver such forecasts, while reconciling them to functional views, is a key enabler of matrix planning, one of the 4 business capabilities identified at the beginning of this presentation. Another key logic feature is the ability to support forward-looking activity-based profit analytics. The model allocates either calculated or given overheads at each stage in the value chain to derive a cost per purchase or a cost to serve. These unit costs are then used to drive product, customer, and segment profitability forecasts. Such forward-looking profit insight provides the means to overcome the challenges that many organizations have experienced with activity-based costing. What they found is that while it provides great insights about historic costs and profitability, it often falls short when determining what to do about unprofitable products and customers. What they've lacked is the ability to answer the types of questions shown on the screen. Predictive analytics addresses this shortcoming by integrating forward-looking activity-based profitability into integrated scenario planning, a business capability identified at the beginning of this presentation. Another thing that's happening as the model simulates these process flows is that it's also simulating the underlying financials. It achieves this by supporting what some call double-entry planning logic. In other words, the model actually simulates the journal entries that underlie planning transactions. What this means is that balance sheet and cash flow forecasts are provided out of the box. This is a key departure for most EPM applications, where this logic must be developed typically from scratch. Another feature of this logic is particularly relevant to supply chain organizations. The logic provides the means to simulate the impact of standard costs on forecasted purchase price and manufacturing variances. This insight can provide visibility into the need for potential standard cost revisions. The next logic difference is lead times, or cross-time period drivers. What this means is that activity in one period drives resource consumption in another. Classic examples of this include the following: purchasing activity driving payment activity 14 days later, outsourced salaries being paid 22 days after work is completed, and sales transaction driving collection 45 days after shipment. Other examples of activities where lead times are involved include the following: inventory purchases 1 month prior to manufacturing, incoming call center calls 3 months after shipment, and quality rework 1 month after manufacturing. Now, lead time is something that EPM systems can accommodate to a point. This is because they often involve adding dimensions to support the logic. As was mentioned before, there's a practical limit to the number of dimensions that can be added to these systems. This is especially true in complex organizations and when lead times vary from one time period to another to reflect policy or capacity changes. Multiple calendars is important because it provides the means to integrate different plans and forecasts, into a single application. It's the vehicle by which lead times based in days, as shown on the screen, can coexist in financial applications that are based in months. As an example, this capability provides the means to support revenue, cost, profit, short and long-term cash flow forecasting, rolling forecasts, sales and operations planning, all within the same application. Most EPM applications cannot support such integrated processes. One of the key reasons is that they don't support the type of calendar logic shown on the screen. One worth highlighting is rate logic, which provides the means to automatically express forecasts in greater detail as time passes. For example, taking forecasts expressed in weeks, months, and quarters and translating them into days, weeks, and months respectively. Such logic is especially relevant to organizations seeking to establish rolling forecasts. Process simulation was introduced earlier when process costing logic was addressed. One of the things that this logic does is to identify when capacity constraints are hit. As this happens, the model is smart enough to understand that profits and cash flow hit a plateau when this occurs. In fact, it can actually adversely affect cash flows, as collection cycles may be extended. This is an example of financial and operational integration that is critical to effective scenario planning that is rooted in operational reality. Cost structure logic defines the business rules that govern the behavior of costs as constraints are met. For example, this could include outsourcing, adding shifts, and other sources of capacity. This often involves step change cost increases related to incremental overhead. Again, such logic is critical to effective scenario planning that is rooted in operational reality. One of the features of predictive analytics is that it can simulate costs across different functions and entities, as represented by the colored boxes on the screen. This enables organizations to coordinate resource allocation across these silos, while also supporting traditional vertical planning. Not only does this optimize revenue and costs, but it also supports more effective tax, cash flow, and foreign exchange planning and forecasting. In fact, in complex organizations, there's virtually no difference between supply chain planning and many financial planning processes. This is a critical point to understand because in global organizations, improving these processes requires finance professionals that understand operations. Planning bills of resources provide the means to define what an organization makes and sells and how they do so. These planning structures are well known in manufacturing as bills of materials. From a planning perspective, this is not a duplication of these bills. Rather, it's a higher level representation of them that is critical to driver-based planning in manufacturing and non-manufacturing settings. Bills of resources play an important role in driving forecast accuracy, but what they also do is to simplify model management and ownership across the organization. An important point to note is that these modeling structures are applicable to other sectors beyond manufacturing. For example, they can define treatment plans and supplies used in a hospital. They can also define the resources and materials required to settle automobile insurance claims. The point is that the structures are relevant to all industries. For those familiar with bill of materials, bill of resources support the same operational logic that comprises most ERP systems, except that planning is done at a higher level. What's unique about predictive analytics is that cash flow forecasting is embedded into the logic structure. These bills of resources are highly relevant to supporting the types of scenarios shown on the screen. For example, predictive analytics provides the means to quantify the impact of strategic sourcing decisions on the financials shown at the bottom. In so doing, it identifies how unit cost savings from one vendor might be offset by increases in other costs such as transportation, inventory holding, quality, and obsolescence costs. The key point here is that bills of resources play a central role in quantifying the net financial impact of potential actions. For organizations where there is a very predictable relationship between sales, inventories, and salaries, as shown on the screen, bills of resources may not be needed. Simple models will often suffice. However, in complex organizations that cope with issues such as seasonality and new products, as illustrated by the graphic on the screen, simple models will not be sufficient to support accurate forecasts and scenarios. In such cases, bills of resources are an essential capability. The last logic difference is distributed model ownership. It enables frontline managers to own any component of the modeling capabilities that have been discussed to this point. One example of distributed ownership can be found in purchasing. Provided on the screen is an example of the types of information that a buyer may be asked to provide. Rather than asking a buyer for a forecast of material purchases, they're asked for inputs to derive purchases from the model. Now these inputs can be used for more than just forecasting. You notice one line called throughput rate. A model parameter such as this may be important when considering whether to source material from two vendors, in this case vendor A or vendor B. These types of inputs support the types of strategic sourcing decisions that we just addressed. This is a different approach than EPM. Rather than finance owning the model, it shares ownership with operations. Now, some may express concern about this. However, it's precisely the same issue organizations had during ERP implementations, when bills of material ownership switched from finance to operations. Provided on the screen is a recap of the modeling logic differences between EPM and predictive analytics that we started with. By now, you should have a better understanding of them. Provided on the screen is a summary of the key differences between EPM and predictive analytics. The key ones are at the bottom of the screen, that being that predictive analytics supports much higher maturity of driver-based planning and scenario planning. These two are important to understand because they are the key factors driving the differences between the value propositions supported by the applications. Provided on the screen are the key business capabilities that were introduced at the beginning of this presentation. Insights from this presentation provide the foundation for more detailed discussions of them in related presentations. Provided on the screen is a summary how the model logic we have just addressed supports the four business capabilities defined on the previous page. Linkages between them were made during the course of the presentation. These will be expanded upon in a more detailed presentation about these four business capabilities. Provided on the screen are the objectives that we started with. Hopefully this presentation provided you with a high-level understanding of differences between EPM and predictive analytics modeling logic. Please feel free to use the contact information on the screen if you have any questions or comments about the material contained in this presentation.